Are we heading into a housing bubble?
Home values appreciated almost 13% in 2020 in the Inland Empire, and they're forecasted to continue appreciating by about 10% this year. We've been hearing a lot of people telling us that they're waiting for this housing bubble to burst, like what we saw back in 2008, 9, and 10, what was called the Great Recession.
So let's look at 3 reasons why this market is completely different than the market in 2007 to 2009. Number 1, for this market, housing inventory is at historic lows. Now, the law of supply and demand tells us that when supply is high and demand is low, prices normally decrease. And this is what happens in a buyer's market. If supply is low and demand is high, prices naturally increase, which is what we're seeing in this seller's market. Now, the normal month's supply of inventory for the market is about 6 months. Between 2006 and 2008, the month's supply of inventory increased from just over 5 months to 11 months. Housing market has been under 5 months for the last 3 years and currently stands at 1.9 months, a historic low. These numbers are national statistics, but we're not that far off from what we're seeing here in the Inland Empire. The lack of inventory is reflected in the lower days on market and homes for sale. In January of this year, days on market for Corona was 9, Riverside was 11, and the highest city was Claremont at 26 days on market. So remember, if supply is low and demand is high, prices naturally increase.
For this housing market, the demand is real. During the housing boom of 2005 to 6, people got caught up in this frenzy and they bought houses based on an unrealistic belief that housing values would continue to escalate, and they were really ignoring the housing trends. At the same time, the mortgage industry fed into the craziness by making mortgage loans to just about anyone, whether they could afford the payments or not. In the current real estate market, the pent-up demand is very real. It's not fabricated. The millennials are the largest generation in the country, and they've come of age to marry, have children, and those are 2 of the major drivers for homeownership. Homes here in the Inland Empire and throughout the U.S. are seeing multiple offers and offers above list price. This desire to own a home, along with historically low mortgage interest rates, makes purchasing a home today a strong, sound financial decision. So today's demand is very, very real.
Number 3, right now households have plenty of equity. Before the Great Recession, homeowners used their homes like an ATM machine with cash-out refinances. From 2005 through 2007, Americans pulled out $824 billion in equity. And that left many homeowners with little or no equity in their homes at a critical time. So as prices began to drop, many homeowners defaulted on their payments due to negative equity, which led to an avalanche of foreclosures. Today, the banks and homeowners have shown they have learned a valuable lesson from the housing crisis. Cash-out refinance volume over the last 3 years was less than 1/3 of what it was compared to the 3 years leading up to the crash.
According to Census Bureau data, over 38% of owner-occupied housing units are owned free and clear. Also, ATTM Data Solutions just released their 2020 Housing Equity Report, and that revealed 17.8 million residential properties in the U.S. were considered equity rich, meaning the combined estimated amount of loans secured by those properties was 50% or less than the estimated market value. The count of equity-rich properties in the 4th quarter of 2020 represented over 30%, almost 1 in 3 of the 59 million mortgaged homes in the United States. If we combine the 38% of homes that are owned free and clear with about 19% of all homes that have at least 50% equity, we see almost 60% of all homes in the country have a minimum of 50% equity. That's significantly better than the equity situation back in 2008.
Now, even if there was a drop in prices, homeowners have enough equity to be able to weather a dip in home values. All projections is that there are no sign of dip in home values, but rather a more reasonable appreciation rate of 3 to 5%. This is nothing like 2008. In fact, it's the exact opposite.
For more information or a current market valuation of your home, call us at 951-660-5926.